A lot of people use like New Year's resolution. I want to do this. No, that's not what I'm talking about. You sit back and going, I want this year to travel more. I want to give more. I want to find a new job. I want to do. This is a good time to reflect on the year and say what worked, what didn't. The other one that's on the checklist, if you really want to be painful, I do this every year, is I take my credit card statements and look at what did I spend on each category for the year. And this is usually where I start cutting out subscriptions and other services. Like it's kind of like a little forensic accounting of your own stuff. It's very painful because you realize how much you spent in like dining out or some of your other trouble areas, Amazon for me. Like everybody has their own like area, but it's a great at the end of the year to look at it and go, all right, this is where I spent my money. Did it match my values and what I care about?
Welcome to the Childfree Wealth Podcast, hosted by Bri and Dr. J, certified financial planner. Here we discuss life and finances as it relates to being child-free. This podcast is for educational and entertainment purposes only. Please consult your advisor before implementing any ideas heard on this podcast.
Hey, Childfree Wealth listeners, we are getting towards that end of the year time. And when we look at the last quarter-ish of the year, and I say ish because it depends on you and the actual timing, we try to do a end of the year checklist with each of our clients. So we're going to bring you through some of the common things we talk about. And you can use this as that, like, how am I doing measure? And what do I need to do before the end of the year? And tax planning is always on the top of my brain at the end of the year because there's some moves you can make at the end of the year that you can't make after the year. There's also some things around debt and insurance and your assets and like cash flow and like all that. But we're going to walk you through it. Now, we have a checklist for this. If you go in the show notes, it has how to get the checklist. So you can go into deep depth on it, but we're going to kind of take it from a high level and we're going to break this into a few different sections and Bri's going to walk us through it. Bri, start off with kind of asset and debt issues.
Yeah, so anytime we're talking about assets and debt, it's going to be whether or not you have any unrealized losses is a big thing. Oftentimes people want to do tax loss harvesting, specifically in your brokerage accounts. So if you've got any there, especially if you have any sort of investment that you do not want to have anymore, it can be a really good time to go ahead and consider selling off some of those investments. And you can take some of that loss and apply it towards your taxable income to help reduce that. You can only do up to $3,000. Everything else from that will then go ahead and carry forward to future years. But it is important to be mindful. So let's say you bought an investment in, I don't know, some purple thing years ago, and it's at a loss. You're like, I don't want that. Haven't had it for years. Really haven't had an interest. It's a good time to consider going ahead and selling some of that and repurchasing a different investment, or if you need the cash, keeping the cash on whatever hand. Those are the big things. Capital gains. Be aware if you have any capital gain income or capital gains taxes you're going to have to pay at the end of the year. Please, please, please be aware of that so you're not surprised when April comes around and that tax bill is due. And then the other thing is if you're subject to RMDs or not, so required minimum distributions, if you've hit that age, or if you have any sort of inherited IRA and need to be taking a little bit of money from those retirement accounts.
Yeah, it's interesting. At the end of the year, I'm always looking at people's investments. I'm like, sell your losers. And they're like, what do you mean? I'm like, it didn't work out. Okay, you had a theory, as Bri had it, that you invested in purple, and it didn't work. This is important. You need to figure out when to say, nope, that didn't work, and just take the tax hit, so we can actually we sell it, we take the hit, we've sold money, we've lost it. Now we can put it towards our taxes. Awesome. Also, there are times where the answer is just to cash out the cash register, pay for the gains, work it through. The RMD question is kind of one of those weird ones and probably where you need some help. As we start aging, so it's usually about 73 for most people right now, and it's the age that changes, you will have to take required minimum distributions out of your IRA, your 401k on the traditional. But the really, really screwy one is inherited RMDs. So you've inherited an IRA, and there's this really stupid, annoying chart of who has to take RMDs when. IRS just put out a ruling recently on how does it work with inherited IRAs. And they're like, oh, well, these people have to do it in 10 years and these people can do it over longer. And like, okay, we decided it had to be done over 10 years, but if you got it 3 years ago, you still have to take it out for it's a mess. You need to talk to a professional, either a certified financial planner or a CPA, to figure out the RMDs, and they have to be taken in this year. So if you inherited an IRA, getting up in the 70s, you need to have a plan for your RMDs. It's just one of those, like, don't go it alone. I'll be frank, even as a CFP, I have to kind of scratch my head sometimes, like, all right, is it this box or this box or this box, and like what percentage and then over what time? It's probably one of the harder things from a tax and math standpoint to figure out because it keeps moving. The IRS, the rules changed actually a couple of years ago, but they didn't give us guidance until this year. Super screwy. If you have RMDs and we're getting here to the end of the year, time to make an appointment to get somebody to help you on that. Selling your losers, you should know to do that. If you need someone else to tell you to do that, you can always pay somebody to do that. So let's keep going on tax planning issues. There's a whole bunch of things here at the end of the year, but we're going to take them a little bit at a time because we don't want to overwhelm you. As we look at the end of the year, we've got to look at how tax laws change, how you're going to change and fit there. Now, we are doing this episode in 2024. I want to call out something. In 2025, the end of 2025, all the rules are changing. Now, it's not every rule technically, but like everything for personal is set to sunset from that Tax Cut and Jobs Act. I've been itemizing and then I didn't itemize and I got the standard deduction change. Like, it's all changing. So you want to be thinking, because we're in 2024, what moves do I want to make in 2025? Because I know the rules are planning on changing. Technically, what's happening is called a sunset. The way it was before is going away. It's changing. And it can have a pretty considerable impact on your taxes, especially if you're a business owner or if you have a large estate or you're inheriting a large estate. The state tax gift exemption is changed from $13 million and change to $7 million and change. We don't know the exact number, but something like that. What that means is, let's say your parents have over a $7 million estate, they could be paying estate tax on that. And if you're inheriting that estate tax can be up to 40% of the entire estate. But you can lock it in 2025. By the way, if you think you're going to run into those estate programs issues, that's, once again, you need a CFP, CPA to work with you on that. There's a lot of moves you can make in 2025. But like, we always want at the end of each year to be thinking about what's going to change next year or the year after and how does it impact. So, Bri, why don't you take us through some of this checklist, because we've got like 100 different things. I mean, it is a lot in taxes.
Yeah, absolutely. The first thing would be, what do you think your income is going to do in the future? Do you think it's going to be increasing or decreasing? Those are important factors to have, especially as you consider your withholdings. Going into the new year, it's going to be increasing. Hey, maybe we need to pay attention. And one of the things that we run into a lot is people have been funding their Roth IRAs. Oftentimes people will go ahead and fund those at the beginning of the year or the end of the year for the previous year or coming year. Like, be very, very, very careful if you are funding a Roth IRA that you are not over that income limit for it. Now, there are backdoor Roth IRAs that you can do, but even then, just be careful and make sure that you are within the acceptable income limit that the IRS has set forth when you're funding those. You can still, this is a confusion that we often hear, Roth 401ks are different than IRAs. There's not an income limit for a Roth 401k. So just be aware of that.
Yeah, for the Roth IRAs, I like to fund those after the first of the year, the following year, because then I actually know what your income was for the year. So you can actually fund those through April 15th of next year, which is the safer way to do that. If you've put too much in to your Roth IRA, your HSAs, your traditional IRAs, you got to get that out before the end of the year. Like, there are penalties for that. Be very aware.
Absolutely. And if you have questions about that, reach out for help, because it can be something that people often get tripped up on. Another thing to consider is any capital losses for the year. Ken talked about it a little bit earlier, selling those losers or anything you have to carry forward from the previous year. So you might want to offset some gains if you have any previous losses. Just pay attention to those. And with those previous losses, you can go ahead and sell some of those winners that you don't necessarily want, because sometimes those winners can have lots of fees associated with them, or you're just not interested in that investment anymore. So those are big things to consider. Another one, are you on the threshold of a tax bracket, particularly when it comes to IRMA surcharges and having to get money out? This is something we often run into clients with, and everybody hates IRMA. Do you want to talk a little bit more about that, Jay?
Yeah, so IRMA is an extra tax. Technically, it's a penalty. It's extra money you're owing on your Medicare because you made too much money that year. Now, by the way, if you're not on Medicare, doesn't apply. IRMA surcharges at the high end, $300-400 a month. It's not the biggest number, but for some reason, it drives people crazy that they're paying extra. And the way it works is there's different brackets for the taxes. And if you go $1 over, you're in that next IRMA surcharge, and it's actually for essentially 2 years later. So your 2024 will impact your 2026 Medicare charges. It's always kind of like, you're like, wait, when did that happen? And how did that, like, you're filing taxes in 2025. Did that, like, it's a confusing thing. But what happens is when we talk about tax planning, we're actually asking the question of, like, what do I do this year in my taxes that impacts years ahead of you? And that's not usually the way people think. They're like, well, I've got this extra income or whatever else it is. I want to sell this stock. That all can impact your IRMA. And you don't want to go over if you don't have to. Also, keep in mind with the tax brackets. I remember I said in 2025, end of 2025, everything's changing. All the tax brackets are going up. It's kind of interesting. The single folks will probably get hit the hardest. People with a bunch of kids will get hit. They'll actually save money. That's not the people we're talking to here. So you're probably in that middle ground where, like, we need to do some planning around it.
Yeah, absolutely. That Tax Cuts and Jobs Act is such a big thing to consider. And you hit on it too, because one of the things we want to talk about is, are you expecting any windfalls? This can be whether it's inheritance, RSUs vesting, stock options, bonuses, potentially leaving a job and getting PTO payout. Make sure you're aware of how much you need to withhold, because you don't want to be stuck in a position where you don't withhold enough, and then April 15th rolls around and you get your taxes done, and here you have a big tax bill plus any potential penalties on there as well. So make sure you're withholding. One thing to note is quarterly payments are supposed to be paid in the quarter that they're due. If you withhold something though, let's say pretend it's October right now, and in December, you're going to be hit with a big RSU vesting. Make sure your withholding is up so you have enough taxes withheld, because that can cover the entire year. Or let's say you had it earlier in the year. Anything you have withheld covers you in the entire year. You don't have to worry about those quarterly estimate payments in the same way that if you're just paying in to the government every quarter. So that's a little bit different.
I've had people go, well, but I want to get a big refund. Or I'm like, listen, your goal is not to get a refund, because if you're getting a refund, you've given a loan to the government. But you also don't want to underpay, because they will penalize you. And it's kind of screwy. IRS will charge you a penalty and interest if you underpay. If you overpay, they don't pay you interest. Okay, come on. We got to get close on this. My thing is, if I get you with like $500 or $1,000 of what you owe, that's probably as close as we're going to get. And what I will do for clients kind of this end of the year time is I'll do like a back of the napkin tax calculation. And there's some calculators online that can help you through that. And you can look at where you think you'll end up. And it's a rough estimate, but it's close enough to go, hey, I underpaid or I overpaid.
If you're trying to do this at home and trying to figure your stuff out, the numbers there is going to be, you have to pay at least 100% of the previous year's taxes owed. Your AGI is over $150,000. Then you need to pay at least 110%, or 90% of the taxes you expect to owe. 90% of taxes you expect to owe, probably going, how do I figure that out? a whole lot of math. Honestly, the other one is a little bit easier to do. But.
So if Bri just like confused you with numbers, that's fine. Like we actually have software, it's called Holistic Plan. We'll put your entire tax return in and it spits out, here's what they call the safe harbor. Like here's like the minimum you got to pay. And we can actually do a scenario and work it through. I use software to figure this out. Like this is not, I've got to memorize it all. We have a cheat sheet. We'll include the cheat sheet for 2025. There's a certain limits. You don't have to memorize all the numbers. You just need to realize, is there anything in my life that has changed or my finances that have changed or that are going to change that I need to plan around?
Yeah, absolutely. And it sounds like a lot of math there. And yes, we use software for it all the time. I think honestly, that's probably one of the easier calculations that I've ever had to do going through all this stuff. So, but it is, the IRS has weird rules.
And they change them every week, it seems to be.
Yeah, no kidding. No kidding. Another thing to consider is if you own any sort of business. If you own a business, your taxes need to be paid up for that, as well as your personal. Another big one, marital status. Has your marital status changed? And whatever marital status you have on December 31st of that year is going to impact what your taxes are, whether that be single, that be married filing jointly, married filing separately. However you do that, just be aware of whether or not you're married on 31st of December, because that will impact your taxes.
Yeah, and I'm going to add on a little bit to this, the business deduction. So there's this thing called QBI, qualified business. That's going away at the end of 2025 again. So that's changing. So you need to be aware of it. One last thing on the tax thing, the question of charities and giving. There's kind of a weird thing now because of the standard deduction being double what it was. You're actually better off doing chunking of your charity donations. So I do more in 2024, and then I'll take the standard deduction in 2025. What is it going to be in 2026? Don't know. So you have a couple of years you can plan around it. If you have considerable income or capital gains or other things for the year, giving the end of the year is going to be a big deal. And you can actually give away appreciated stock. So rather than paying the capital gains on it, you can actually give the stock to charity or in a donor advised fund or a few of these other tools and get credit for it. Now there's limits in how much you can write off each year and all that. If you're going to make big charitable deductions, that's once again a good place to get a professional. But the time to do that is we get to the end of the year, we're like, that's when we should make some decisions about, should I do it this year? Should I do it next year? You can actually give the money into what's called a donor advised fund and then give the money away over the next couple of years. But which year do you take the taxes in is what matters. So that's a bunch of tax stuff. Talk to me about cash flow because this does matter.
Yeah. So big thing. We're seeing a lot with student loans right now. And I know there's the whole student loan fiasco and things are being put on pause again and there's forbearance. But one of the things to consider is if you have a little bit higher income and you're going for any of those income-driven repayment plans, oftentimes we'll talk to clients about putting as much as they can away into a traditional 401k to lower that income and help lower what those payments are every month. And so if you know you want to max out your 401k, but you actually haven't went ahead and looked, double check that. If you're over 50, be aware that there is the catch-up contributions for both those, the 401ks and the IRAs. So just make sure you're aware of that. And if your intention is to put as much as possible in those, that you're doing that. Another big one, HSA. Oftentimes you'll see people have an HSA. They are not maxing out what they can put in there. And then they're also using that money to pay for medical expenses now. Big thing with that is you can invest that money. And so it's like a triple tax benefit, which is really, really helpful. And paying out of pocket versus paying money from HSA. So are there anything that you can put money in and save yourself a bit on taxes there going forward? That is one of the big things. 529 accounts, if you are intending to save for, those are education accounts, but if you're intending to save for whether it be a niece or a nephew or a friend's child or anybody, maybe yourself, we don't run into that too often. It's mostly planning for somebody else's child. We'll run into those 529 accounts. Just being aware of how much you can put into all of those accounts and getting that done by the end of the year.
Once again, we'll get some changes in 2025. There's actually changes to the additional amount somebody over 60 can make put into a 401k. So you may want to make some of those adjustments. They also are they adjust every year because of anyway. The 529, my wife and I actually have one for our nephews. We put in actually a certain amount each month, whatever that is. You want to see that. Also, if you have a 529 and you've had it for 15 years, you can actually put some of that into your Roth IRA. Kind of a weird thing. Don't just do that on your own. Once again, there's a couple steps behind that. It's a balancing act. I think what I'm trying to get you to do at the end of the year is look and see how's your money going to change in the next year, and has any of the tax stuff or the retirement savings changed what you should be putting aside? Either should I still be putting in Roth, traditional? Can I put an extra amount? Did I get over 50? All these weird things. You want to have that plan now because let's be real. If you go into the HR system and say, hey, up my 401k contribution, it may take a few weeks or a month before it actually takes effect. I had somebody recently who had to go down to the HR office, sign a physical copy of it, and then it takes a month to 2 to process. I'm like, man, there's technology to do that, but we got to think ahead. All right, let's keep going. We're going to finish off we got insurance, estate, and then other issues, but let's start with insurance issues.
Yeah, so one big thing is FSAs, those flexible spending accounts. Being aware if you have any money left in there. If you do, some companies will allow you to roll over a little bit, but that is some companies. Typically, flexible spending accounts are use it or lose it. So if there's money left in there, I hope you like Tylenol, I guess. Start buying whatever you can if you need new glasses or there's appointments. You have big things you need to use that money somehow. Otherwise, you went ahead and set money in there and it's gone. So be aware of that.
Yeah, and just to be careful, FSAs are use it or lose it. HSAs, you can invest. People get confused. They're both for healthcare. They're two completely different systems.
Absolutely. So you can have an FSA even if you do not have a high deductible health plan. So that is one of those things to be aware of. And if you have a balance on there and you're going into looking the next year and you're saying, hey, I have a bunch of money in here, I've hardly touched it, maybe consider not having one for the next year if you don't think you're going to have medical expenses or they're going to be about the same as the year before, because we don't want to be putting money into there and then not using it. One other thing to consider is, have you met your health insurance annual deductible? If you have, it's a great time to go ahead and book any of those appointments that you want to get in. Maybe you wanted to see a certain doctor for something for a while and you haven't. Go ahead and get that booked because you're already at the deductible. So any of your continuing expenses will be covered by insurance.
Yeah. This is where, if you actually look at hospitals, the number of people doing knee surgeries towards the end of the year goes up. So it's well, I didn't have to get it done, but I've hit my deductible. Let me figure this out. It's smart. You're let me figure out what I have left to work with. If you've hit your deductible or your out-of-pocket max, everything else is free. Seriously, let's go take advantage of it. I'm not saying get medical procedures you don't need. I'm not saying, how about all the preventative maintenance stuff you've been putting off? Or, those surgeries, of course, are a great example of things I've been needing to get this done for a while. Work that through. So let's keep going. Estate planning issues and other issues.
Yeah. So estate planning, have there been any changes, whether it be your family or any, the people itself in your family, but also buying and selling any assets? Are there any gifts you want to do? So each person can give another person up to $18,000 in 2024 tax-free. That's something to consider if you're wanting to do that. And then, we already hit on it, but the Tax Cuts and Jobs Act, any new laws that are going to impact things. So, the Tax Cuts and Jobs Act, all of those lowered tax rates and then higher estate tax are still in effect for 2025. If there are some bigger things, estate planning wise and inheritance planning wise, that you need to look at, 2025 is going to be that last year in order to get that done with the current laws.
Yeah. And by the way, our checklist also includes Do you have kids in high school? No, I don't. So I can just say no on those. Like, ignore that. These are part of standard places. There is a question there. Do new laws go into effect that are impacting you? Yes. I'm just going to answer that. Yes. You don't have to do the checklist. The answer is yes. I think the other one that's not on the checklist is taking a moment to figure out, has my life changed or my goals changed? And does my financial plan still? A lot of people use like New Year's resolutions. I want to do this. No, that's not what I'm talking about. Like, you sit back and going, I want this year to travel more. I want to give more. I want to find a new job. I want to do. This is a good time to reflect on the year and say what worked, what didn't. The other one that's on the checklist, if you really want to be painful, I do this every year, is I take my credit card statements and look at what did I spend on each category for the year. And this is usually where I start cutting out subscriptions and other services. Like, it's kind of like a little forensic accounting of your own stuff. It's very painful because you realize how much you spent on like dining out or some of your other trouble areas. Amazon for me. Like, everybody has their own like area, but it's a great at the end of the year to look at it and go, all right, this is where I spent my money. Did it match my values and what I care about? And the other test on that is like, I spent X amount in this category. What the heck did I spend it on? And there are times where like, I don't know. If you don't know what you spent it on, it probably didn't match your values or your goals. Yeah, I'm not trying to like call out people's avocado toast. That is not the point. The point is, what do you value? And is your money going there? Yeah, it's a good opportunity to say, all right, next year I'm going to make sure I do that. And ideally, I want you to set up an automation system for next year so that it just magically does it. The last thing on the checklist, since we're getting to the end of the year, is did you pre-order the Childfree Guide to Life and Money? Comes out December 31st, end of the year, new year, do you. I got to say it, like we're trying to make a bestseller list. Bri's laughing at me, but put it on the checklist. Did you pre-order the book?
I mean, that's one point. Like, I was going to say, this takes time to get these things done. And if you want to meet with us for Childfree Wealth Checkup, to get that scheduled now, because I can guarantee at the end of the year, we're not going to be rushing to get any of those in. There's not going to be space, but hey, yeah, buy the book as well.
Yeah, it's Bri's probably better on what she just plugged, but I think the other part of it is if you have like account moves, tax moves, other things that you want to get done by a year, most of the brokerages, like if you have an account with Vanguard, all that, stop taking requests towards the end of the year. Like, there's a certain cutoff date when it has to be done, when this has to be looked at. Yeah, I can't wait till the last minute. If you're a small business, if you need to open a solo 401k, it's got to be done during this calendar year, next year. Like, there are hard and fast cutoffs. You need to think ahead, but hopefully this has helped you.
If you enjoyed the show, please consider leaving a rating or review. We'd love to keep the conversation going. Please let us know your thoughts wherever comments are available, or email us at media@childfreewealth.com. To stay up to date, find and follow Childfree Wealth on social media. If you're interested in working with us, learn more by visiting our website, childfreewealth.com. We'll see you next time.